Hello, everyone. Hope you're having a nice night. I want to talk about the way to develop a trading idea. Now, this is a technical trading idea. It's not fundamentals, it's technicals. Technicals are like you see what's going on in the market and you react. Short term, you're not really thinking about, the earnings or what this broker said or what this person said in the short term. In the long term. So you might hear some crazy noise going on outside my window there, but that is our cicadas and our spring peepers. Now, I live in Connecticut, and believe it or not, the top 10 most mysterious animals in the world, according to this one show I watched, two of them are in Connecticut. We got our spring peepers, which are these little frogs, and they can freeze ice solid and then somehow come out of it and live. And we got the horseshoe crabs. But let's get into the United Healthcare Group. One of the ways that we like to develop trades is we look at the sector. The S&P 500 is made up of 11 different sectors. And if a sector looks weak, well, just by definition, there are going to be stocks within that sector that look weaker because a sector is just the aggregate or the average of all the stocks that were in that sector. So I'm going to bring up this ETF, XLV. This is the Spider Healthcare Fund, which tracks the healthcare sector. Now look at this. We can see here how we just got up to a resistance level and we sold off. And then we actually sold off pretty big. Wow. I didn't even look at this today. I saw it during the day, but I didn't look after the close because I was busy moving my daughter's stuff out to go ready to go up to college. But wow, that's a nasty self. Anyway, I looked at this and there's resistance here. Why is there resistance here? Well, there's resistance here because there was resistance here. And you got all these investors who bought back here who, once the price goes lower, they're like, gosh darn it, I shouldn't have bought. I'm going to wait. And if this thing gets back up to the price level I bought at, I'm going to sell it. So if you have enough of these remorseful buyers placing sell orders, the level that was resistance becomes resistance again. And then the same thing happened here. Now, think about the dynamics. We get up to the resistance level, and a lot of the investors who want to sell or traders who want to sell start looking around and start thinking, wow, the market's not moving any higher. There must be enough supply now to fill up all the demand. So the buyers won't need to pay higher. Oh, there must be new sellers coming into the market. So let me go in there and reduce my price because the buyers are going to go to whoever is willing to pay, whoever is willing to sell at the lowest price. All right, excuse me while I have a cough drop. Now, one of the stocks in the healthcare sector is UNH. And this is where our lesson really begins. Well, I guess it's kind of been gone already. The best traders let the market tell them what to do. They don't guess. They don't get their ideas out of a chat room. Now, they let the market tell them what to do. They're agnostic and they let the market tell them what to do. I know firsthand because I've worked with some of them. I'm not claiming I ever was one, but I know firsthand from working with some of them. Now, let's take a look at this. This stock blasts off. I don't know what the news was. Maybe there was no news. We go into this sideways trading range, and now we're below it. When a market is really ripping higher like this, it just blasts through these levels, okay? There's not a lot of time at each price level for there to be some sort of huge amount of vested interest or whatever you want to call it. So we just blast through these levels. Now look over here. Notice how the level that was resistance converted into support. How could that possibly happen? Well, there are investors who sold here who regret doing so when the price goes lower. And then they sold here. They're happy when the price goes lower, but then when the price goes above the price they sold at, they're like, man, I made a mistake. I'm going to buy my shares back. So one of the main reasons why you get support at a level is because you have remorseful sellers placing their buy orders at the level that was support. When you rip through levels like this really fast, there's just not enough time for there to be a lot of, there are sellers obviously, but we just blow through these levels really fast. There's not enough time for there to be a lot of vested interest for them. So there's a good chance that we make a decent move lower because when sellers come into this market, they're going to have a hard time finding buyers. Now, as someone who was an institutional trader, I can tell you this. Say I had a big order of sell 100,000 shares or buy 500,000 shares or sell 400,000 shares. Well, here it's like, okay, you go into the market. Hey, I got to sell 500,000 shares. There's someone who's willing to buy it from you. Hey, I got to buy 500,000 shares. There's someone who's willing to sell it to you. The equilibrium is, well, it's in equilibrium here. When we're here, if you come into the market as a buyer, it's like, hey, I got to buy 500,000 shares. Guess what? It's like there's no sellers around. So you got to be willing to pay higher prices. Now, on the way back down, when sellers come into the market, they're going to be like, hey, I'd like to sell my 500,000 shares here, but maybe they can't. They have to offer their shares out at a discount. Maybe instead of saying, all right, I'll sell them at 485, I'm going to sell them at 475. And that forces a downtrend. So when you blast through levels really fast like this on the upside and you get a reversal, you can move through it going back down on the downside. You've probably heard the phrase gaps refill, and it's the same concept. If you gap through price levels where you don't trade, eventually if the stock or the market or whatever is you're trading turns around and gets back to those levels going the other way, it's the same thing. It'll probably move really fast back through them, or there's a good chance. Because at those levels, if we gap through them, there's not a lot of time for invested interest to form. As a matter of fact, there's no time because it never trades there. When you get to a level like this, there's a lot of vested interest. So if we got back up here, I would imagine we would spend some more time in this range here. Now, let's just go look at this. And you can look at this chart and you can easily see. Actually, let me go through this first here, just before I move on to the more, a different part of the lesson. Here we have an example of buyer's remorse. Here we had seller's remorse. Investors sell, price goes higher. A lot of them are like, oh, I wish I could buy my shares back. And you could see that. You could see that here. Sellers sold here. They want to buy their shares back if they get the same price. So what was resistance becomes support. But when you blow through these levels really quick, there's not a lot of time for there to be a lot of vested interest, or sellers, they're going to want to buy their shares back. So now let's look at buyer's remorse. There are investors who bought here who thought they were, the new great hedge fund trader. But when the price goes lower, a lot of those investors are like, man, I made a mistake. I want to get out, but I'm only going to do so if I can get out at break even. So if you have enough remorseful buyers placing sellers, what was support converts into resistance. So remember, in the market, certain price levels are more important than others. It's just how it is. And I say that every day. And I don't care if people are getting sick of me. It's like, hey, if you're an auto mechanic, every day when you're working an engine, you got to make sure that filters are clean, right? You got to make sure there's fresh oil. Well, if you're a trader, you got to know where the price levels are. And we could go back here and we could see these examples all over the place. Right over here, we got support becomes resistance. When you know where these price levels are, it helps your trading because it helps you know where you can put in your prices. When the market gets to an important price level, it tends to reverse, like here or here or here or here or here. I mean, I'm not going to tell you like I can guarantee if I'm going to give you X percent a year. You can take your $20 and turn it into like a vacation home in Miami. But if you want to learn how the markets really work, I'm a good person to learn it from. I mean, I don't have all the answers, but I can just kind of show you some interesting stuff that goes on. Now, remember over here, we have the potential of moving fast up and then moving fast down. You don't have enough sellers who want to buy their shares back, who are remorseful, to really kind of put some support under this. You could see this happened here. Fast move up, fast move down. Now here we have the opposite dynamic. Fast move down, fast move up. What do we just talk about? Support can become resistance because of buyer's remorse. When you blast through these levels really quickly on the downside, you don't have a lot of time for there to be enough or, a lot of vested interest for there to be a lot of buyers who are going to want to sell on the way up. So we blast down really fast. We go up really fast. Okay. So just remember, thank you for tuning in, but just remember certain price levels are more important than others. If you can understand the concept of how support can convert into resistance because of buyer's remorse, and resistance can convert into support because of seller's remorse, It's going to put you ahead of the game of most newer retail traders or even institutional traders. Okay, everybody, thank you so much, and I will see you soon.